I want to talk markets with Julie Biel, portfolio manager and senior research analyst at Kayne Anderson Rudnick. She's also a CNBC contributor. Good morning to you. How much did these Jim Bullard comments change the dynamic, or did they?
I don't think they do change the dynamic, because if you're thinking about positioning for this year, it's more a function of what's going to happen with earnings. And I think people are still trying to figure out the direction of the Fed. And the Fed really hasn't changed their point of view, right? They've been saying, if anything, we're going to err on the side of over tightening. And so I think if you're, any kind of investor, it's sort of like, being a husband and being told throughout the week what's going to happen on the weekend and kind of ignoring it and then being shocked that you're at a soccer tournament for 8 hours. Like, they haven't changed their tune. They've said it over and over again. And I think it's time for the markets to kind of take stock of that.
Well, if they're going to take stock of that, then we should not be in the green. We should be in the red, right?
Yeah, I mean, I think day-to-day movements are going to be driven by, sentiment and excitement over, possible rate cuts. But I think if you think of why the Fed would be cutting rates, it's probably because the economy is in some sort of tailspin. So that's not great for risk assets. I think for your longer term investors, you should still stay invested. I'm not calling for being fully defensive, but I think you have to protect yourself against any kind of slowdown that may be coming.
Okay, so what does that mean, though, to you? If it's not to be fully defensive, what would you be doing?
I think looking at businesses that have real structural protections. So, I think of ones where, like an Old Dominion, where you have some route density, something like a Copart, where you have parts, you have sites that just can't be replaced. Those are structural protections, and so they tend to be better protected competitively. Or businesses in healthcare that are, serving stronger sectors, but not necessarily dependent on FDA approvals.
What about tech? What do you do about tech right now?
I think tech is not a monolith, right? I like the tech that's focused on customers that are going to be well positioned to keep spending. A lot of these SaaS businesses, they're not really delivering on a lower total cost of ownership. And so I think you could see seat counts coming down, and that's going to hurt larger tech. But the ones that are serving government, like a Tyler Technologies, they're better positioned because those guys are pretty flush with cash right now to spend.
But what do you tell all the viewers? I mean, there's so many viewers who are still hanging on, holding on to FANG stocks. And they look, and some of them are saying maybe there's a value play here at this point?
I think some of them are a value play, right? If you think about Google, the way that is trading right now, it's pretty attractive in terms of its pricing. And, it has such strong competitive protections around its business. I actually think the introduction of ChatGPT is helpful to Google because it gives them a better place to argue with the FTC about market concentration and competitive protection.
Right. Smart point. Julie, thank you for joining us this morning. Great to see you. Appreciate it.